Right then, hello everyone, and we are at the end of another week of trading, and a pretty choppy week of trading. Markets lied in wait for the US CPI yesterday, which did not provide us with the moves that many market participants will have hoped for. But if you look back towards the start of the week, we started with a downgrade of US banks from Moody's. A number of small to mid-sized small to mid-sized banks were downgraded by Moody's, and there was reports of them looking at targeting slightly larger banks. Now, after the slight banking crisis earlier on in the year, that brought some jitters into markets, and markets sold off of the back of that. The market popped higher again, they popped back lower again, and there's been strength one day, weakness overnight, strength the next day, weakness overnight, and weakness during the day, and strength overnight. It's just been a bit choppy, up, bit down, certainly in terms of the equity markets, which we'll have a look at now once we get around to it in a minute. We were bereft of any high impact economic data on Monday. On Tuesday, not really too much worth paying attention to. We did have Chinese CPI on Wednesday. Now, Chinese CPI having their first deflationary reading in over 2 years. We can see the actual print of minus 0.3%, so not as bad as the consensus feared, but first deflationary reading from China in just a little over 2 years. So the deflationary print in China, if that was to feed in, or a lot of market participants seem to think it may feed in to the rest of the global economy, which would be a positive in getting inflation down. Like, I was reading an article on Sky News and stuff, saying that people should be worried about disinflation, or deflation should I say, in China, and how that can lead into the rest of the world. But in terms of cost of living for people, deflation isn't really that bad a thing in terms of getting prices under control. Obviously it's a negative for growth and things like that. Hopefully unemployment doesn't rise too far, but disinflation is not exactly a bad thing for a lot of people. Most people, I don't think, should be too worried about that. A little bit will be absolutely fine. In terms of inflation then, on Thursday, we've obviously had CPI yesterday, which markets lied in wait for. Really Monday, Tuesday, Wednesday, which is why we saw the choppiness across equity markets, choppy across the US dollar, and really nothing of note really happened until that. And then we got this out pretty much all in line with expectations. The core CPI print for the month of July, 0.2%, bang in line with expectation. The CPI print itself, once you include food and energy prices, 0.2%, in line with consensus. Really nothing has changed. That's steady, more manageable rates of inflation. The core CPI print year over year, 0.1% below consensus, did pull back slightly, and the headline figure year over year, consensus was for an uptick of 0.3%, actual 3.2 should I say, so slightly below consensus. But I mean, what do you read into that? I haven't got a clue. I mean, in terms of going forward to the Fed's next meeting, you'd have to imagine that they'll wait on the next inflation print to make the decision off the back of this. If I had some strong economic data over the course of the last number of weeks from the US, and this is just pretty in line with expectations, ticked up slightly the CPI print itself. So what that means going forward, then, it doesn't really mean much in terms of the way of, if it was a beat on consensus, you'd expect another interest rate hike. If it was a solid miss on consensus, well, then you'd expect that they are done. In fact, you're in line with consensus, in line with previous. It really doesn't change too much. So inflation remaining somewhat sticky, the downtrend not continuing. Total rate of inflation did break its downtrend over the last year, and inflation continuing to be somewhat of a problem. Equity markets didn't like it over the course of yesterday. Spiked higher initially and then sold off quite aggressively then after that, but we'll have a look at some charts now in a minute. GDP out of UK, raft of high, positive economic data. There's a number of medium impact kind of manufacturing figures and stuff which were positive as well. All three of these beating consensus. Year over year figure for Q2, consensus 0.2, actual 0.4. Quarter over quarter figure, consensus 0%, actual 0.2, and then GDP over the month of June 0.5 versus a consensus of 0.2. So positive data across the board, but I mean 0.4% growth in a year is not exactly positive. I mean, it's basically flat. 0.2% over Q2, again, it's not exactly positive, but it's pretty flat. But the positive, it's not in contractionary territory. The economy is still growing slightly, so that's absolutely fine. Especially over the month of June, a 0.5% increase is a solid number in the month of June. We do have PPI, Producer Price Index, the cost of producing goods, a little bit later on. So it can be a front runner for CPI. So keep your eyes peeled on that once we get around to it at 1:30. That Michigan consumer sentiment, I'd prioritise the PPI over the Michigan consumer sentiment. And a quick look at charts, we can see stock indexes. I mean, what do you do with them? We suggested earlier on in the week to buy the lows and sell the highs, which proved pretty fruitful in terms of being able to buy the absolute lows and sell the absolute highs. Maybe a little bit more difficult to trade, as you didn't get the clear identifiable support and resistance levels, but an extremely aggressive range. I mean, aggressively lower, aggressively higher, aggressively lower, higher, lower, higher, lower, all aggressive moves. So difficult to trade. You would have been hoping for a breakout, or we were hoping for a breakout either side. You come up to the top of the range aggressively, you're like, right, okay, we get a breakout to the top side, and you come down to the low of the range aggressively, you think, right, we're going to get a breakout to the downside, and it just never materialized over the course of the week, unfortunately. S&P, Dow Jones, the Nasdaq, and the Russell all remaining range bound as well. You can see the DAX range bound, Euro stocks grinding higher, but yeah, still relatively range bound when you look at it. The FTSE grinding higher, apart from this morning. On the back of those strong figures, means the central bank do have a bit more wiggle room in terms of increasing interest rates, which is obviously negative for the stock index. In terms of the US dollar, pretty choppy as well. The dollar did strengthen post CPI yesterday, not in the initial release, but strengthened pretty aggressively after that, as yields then pushed higher. But you can see pretty choppy across the Aussie dollar. Kiwi dollars are kind of the one with a more clear direction today, but Tuesday and then Thursday were the two downside days. The other days were a little bit choppy, but euro dollar cable now pretty difficult to trade. Dollar Swiss, dollar CAD chopping sideways. The one with clear direction is dollar yen. Japanese 10-year yield pushing lower has driven some downside again in the Japanese yen. So clear directional trend on the Japanese yen, or on dollar yen should I say. Really, dollar yen is the only solid trading opportunity of the week if you manage to jump on board. In terms of yields pop higher, and yields are set to close higher for the fourth consecutive week. US dollar set to close higher for the fourth consecutive week, and a pretty aggressive move. Yields higher, longer dated yields especially, 10 years and after, off the back of that CPI print yesterday. So maybe shows where markets are thinking going forward, but still a lot of data to come out between now and the Fed's next interest rate decision. Oil higher on the week, certainly as of now, higher on the week. Saudi Arabia and Russia, their output cuts, their cuts to supply, continuing to take effect in the oil market itself. We did have that slight pop lower. We were looking for a break of that head and shoulders on Monday or Tuesday, of this week. Did pop lower, then obviously rebounded off 80, as you can see down here, and popped higher quite aggressively. Really, dollar yen was the best tradable opportunity this week. Really was the only clear-cut trading opportunity. I mean, gold continues to push lower, continues to grind lower, and the more yields push higher, the more lower gold should go. So something to keep an eye on into next week. Gold is not bad, actually, to be fair. Not something I trade personally, but not a bad move on the way lower. Apart from that, heading into next week, we'll have another video on Monday detailing next week. So I'm going to wrap it up there. Have a good weekend, everyone. Do switch off the batteries, do recharge the batteries, should I say, and switch off from markets. Do enjoy yourself, and we'll be back next week for another week of trading.